Hi, my name's Jessica Rabe, co-founder of DataTrek Research. We've seen some unwinding of the American exceptionalism trade this year with the MSCI All Country World ex-US Index, or ETF symbol ACWX, up 9.3% year to date versus the S&P 500's loss of 1.8%. For today's video, I'm going to analyze the American exceptionalism trade by reviewing the difference in holdings and long-run performance of U.S. large caps versus rest of world stocks. Let's begin with the sector and top 15 single stock weightings for each index, as well as the country weightings and ACWX. I have 3 points here. First, this table compares the S&P and ACWX's sector weightings with the difference between the two in the last column. Sectors highlighted in green are overweighted in the S&P, and those in red are overweighted in the rest of world index. ACWX overweights 5 cyclical sectors: industrials, financials, materials, consumer discretionary, and energy. 1 rate-sensitive group, utilities, and 1 defensive sector, consumer staples. The S&P overweights big tech-heavy sectors like technology and communication, another growth sector in the form of healthcare, and 1 rate-sensitive group, real estate. The upshot here is that non-U.S. equities are a play on global economic growth, while U.S. large-cap equities are more leveraged to disruptive innovation at global scale. Next, here are the top 15 positions in each index and their weightings. The S&P holds almost every systematically important tech name in the developed world, public companies with global reach and strong competitive positions. Further down on this list are a mix of well-run global businesses managed to the American system of profit maximization and a focus on shareholder returns. As for All Country ex-US, it has 4 strong global tech players: Taiwan Semi, ASML, S&P, and Samsung, and 2 of China's local big tech companies, Tencent and Alibaba. The other names are a mix of pharma, energy, consumer staples, luxury brands, banks, and industrials. As much as they're all strong companies, they're not generally as exposed to the growth potential of disruptive innovation. Now check out their weightings. The S&P 500 is 42% its highest value names, whereas ACWX only owns 15% of its most valuable companies. We think that makes the S&P the superior index in terms of potential long-run future returns, even if it is a lot more concentrated and can therefore be more volatile over the near term. Next, here's a table that shows ACWX's geographic weightings next to the table with the S&P and ACWX's top 15 holdings. When you look at these lists, would you rather own just the US names or a stock portfolio tied to the countries listed in the rightmost column? While there are excellent companies in each geography and some promising countries, we find it hard to argue for that list in its entirety when compared to the US. The performance differentials between US equities and all country ex-US stocks support that conclusion. Here's a table that shows ACWX and the S&P's cumulative total returns over the last 3, 5, and 10 years. The numbers here are as of February 28th, 2025, which is the latest available data. The takeaway is that all country ex-US equities have grossly underperformed US large cap stocks over each time frame. To put this data in perspective, the difference in the 3-year performance between US and non-US stocks on a $1 million investment is $280,000. Over 5 years, the gap widens to $740,000. And lastly, the difference over 10 years is $1.8 million, almost twice the original investment. Across each time horizon, therefore, investors have left a lot of money on the table if they had any exposure to a diversified portfolio of non-US stocks. Moving on, here's a chart showing 2-year trailing correlations of daily returns between the S&P 500 and all country ex-US since 2011. As a reminder, correlation measures how closely two variables relate to each other. Correlation of plus or minus 1 reflects a perfectly positive or negative linear relationship. A zero correlation says there's no linear relationship between the two variables and that they move independently of one another. And lastly, anything in between indicates some relationship, and the closer it gets to plus or minus 1, the tighter it is. Now I have 2 points on this chart. First, the average 2-year correlation of daily returns between US and non-US stocks has been in a downward trend over the last 15 years. At the start of 2011, it was 0.94, which into statistical terms is an R squared of 87%. This means that 87% of all country ex-US's price action could be explained by what was going on with US large cap equities on any given day and vice versa. That's a super strong relationship, likely due to the economic fallout of the global financial crisis, since correlations tend to get close to 1 when investors panic or are especially uncertain. The spike to the mid-right of the chart with a correlation of 0.9 was due to the 2020 pandemic crisis and another instance of high correlations due to market stress. Second, the 15-year low in US and non-US stock correlations was yesterday at 0.73, an R squared of 53%, meaning that about half of ACWX's price action could be explained by its own fundamentals over that period. The takeaway here is that non-US stocks have been increasingly charting their own path over the last 15 years. Given the difference in holdings I showed you earlier, that's understandable, but the correlation data shows the real-world effects of such dramatically different portfolio constructions. Building on that idea, here's a chart showing the relative performance of the S&P 500 and MSCI All Country ex-US over rolling 2-year holding periods back to 2011. When the blue line is above or below the x-axis, the S&P is out or underperformed ACWX by the amount shown on the y-axis. And I have 3 points on this data. First, despite the S&P's underperformance this year, it has an excellent long-term track record of beating rest of world stocks over a 2-year holding period. Since 2011, it has done so 98% of the time. Second, on average, the S&P has outperformed ACWX by 19.6 percentage points over any given 2-year period over the last 15 years. The standard deviation around that mean is 8.4 points, which means even at a 2 sigma downside reading of 2.8 percentage points, the S&P still beats ACWX. That's pretty remarkable. History shows how rare it is for all country ex-US to best the S&P. Its last major win was in 2011 at 15 points, where non-US stocks were hit harder during the 2008 financial crisis, but then rebounded more strongly in the 2 years after. ACWX also briefly outperformed in April of 2018, but for literally just a few days. Third, the S&P's peak 2-year outperformance of 47 points in January 2025 was a 3 standard deviation move, so it was extremely unusual. As rest of world stocks stage a catch-up trade now, the S&P is still outperforming by 23 points over the last 2 years. Even from here, it would take a 3 standard deviation move for ACWX to outperform over the next 2 years. As you can probably tell from the chart, but we'll say it explicitly, rest of world stocks have never gone on to outperform over the following 2 years after similar periods of relative underperformance. The takeaway here is that rest of world stocks got extremely oversold earlier this year, so some mean reversion makes sense, especially with the catalyst of German and Chinese fiscal stimulus and uncertainty surrounding the new administration's trade and fiscal policies, both of which have hurt U.S. investor confidence. Even still, The last 15 years of history shows it takes a relatively rare confluence of events for U.S. equities to lag their international peers over the medium term. Capital flows to where it is best used, and in the case of global equities, that has been to U.S. large caps for well over a decade and is therefore not an anomaly. We do believe rest of world stocks are a decent trade here, and we have been advising clients to be equal weight the group. Additionally, their low correlation to U.S. equities is a feature for diversified portfolios. Over the longer term, however, the data I've shown you today reflects the core of the American exceptionalism trade. Investors are more confident in the American system of capitalism and approach to disruptive innovation relative to the rest of world's approach. The US has the world's reserve currency, best medium-term productivity growth, and represents over half, or 57% in 2024 more specifically, of global venture funding to finding the next disruptive tech companies that can drive long-term U.S. equity returns. This confidence in U.S. equity has waned of late, but the S&P has outsized exposure to U.S. tech companies that are globally scalable and are market leaders with large competitive moats. We believe they'll continue to prevail over the long run, and if new companies emerge to challenge them, they'll almost certainly be based and listed in the U.S. With that, thank you very much for taking the time to watch this video. Please hit the like and subscribe buttons and share it if you enjoyed it. You can also sign up for a 2-week free trial on datatrekresearch.com to receive our daily market newsletter. Thanks again for watching, and we hope you have a great day.